As the U.S. markets are closed for the weekend, we are looking at the final figures from Friday, November 7th, 2025. SoFi Technologies, ticker SoFi, ended the last session at $28.21. This was a significant move, a rebound of $1.07 or 3.87% on very heavy volume of nearly 79 million shares. This rally might look like a simple sigh of relief, a bounce back after the stock was pummeled the day before, dropping almost 10%. But this isn't just random volatility. This violent swing from a low of $25.66 to a high of $28.24, all in one session, represents a fierce battle being waged over the very identity of this company. The expectation for SoFi has become a tangled narrative. On one hand, it's seen as the poster child for new age fintech, a one-stop shop that's rapidly acquiring members. On the other hand, it's often dismissed by bears and traditional analysts as just another high-growth, cash-burning neobank, dangerously exposed to a weakening consumer. The reality, however, is that SoFi just delivered a quarterly report that directly challenges that entire bear thesis, and the market is now trying to figure out who is right. The general belief, and one that is heavily reinforced by Wall Street, is that SoFi is walking a tightrope. In an environment of high interest rates and persistent inflation, any company in the business of personal loans should be seeing cracks. The expectation is that credit quality must be deteriorating, that loan defaults are rising, and that its growth is coming at the cost of profitability. This is precisely why the analyst consensus rating on SoFi remains a lukewarm hold, with many price targets sitting stubbornly in the $25 to $27 range, which is actually below where the stock just closed. The market expected trouble. But on October 28th, SoFi reported its third quarter 2025 earnings, and the reality of its performance was a stark contrast to those fears. The company didn't just beat expectations, it delivered a statement. GAAP net income came in at a solid $139 million. Earnings per share were $0.11, smashing the $0.08 analysts were looking for. Revenue was a record $961.6 million, soaring past the $887 million consensus. This is where we have to look past the headline numbers. The single most important part of that report, the detail that directly refutes the primary bear case, was credit quality. The market expected defaults to be rising. The reality? SoFi's personal loan net charge-offs actually fell to 2.60%, their lowest level in over 2 years. Delinquencies held stable, student loan charge-offs also eased. The company is not lending to subprime consumers. Its personal loan borrowers have an average FICO score over 745. This wasn't a fluke. It was the result of a deliberate strategy to diversify the business away from being just a lender. The company's operations are now clearly in 3 distinct segments. The lending segment is still strong, with record $9.9 billion in originations, but the financial services segment, which includes SoFi Money, SoFi Invest, and its other banking products, saw its revenue skyrocket by 76% to $420 million. The technology platform, anchored by Galileo, grew a steady 12% and is now supporting 158 million accounts, recently powering a new co-branded debit card for United Airlines. This diversification is the key. Fee-based revenue from these newer segments now accounts for 56% of SoFi's total revenue. The flywheel that management has been talking about for years is no longer a theory, it's a profitable reality, with 40% of all new products being adopted by existing members. This brings us to the short-selling activity, because despite that blockbuster report, the short position on SoFi remains significant. As of the latest data, there are over 100 million shares of SoFi being held short, which represents about 8.47% of the float. This is not a small bet. The short thesis is not based on the idea that SoFi's Q3 report was bad. It's based on the idea that Q3 was the peak. The bears are making a purely macroeconomic bet. They are looking at the same high interest rates and persistent inflation and concluding that, eventually, this must crack SoFi's consumer base. They are betting that the solid credit performance is temporary and that the company's valuation, with a price-to-earnings ratio north of 50, is unsustainable in a slowing economy. What's your take on the analyst consensus? Are they right to be cautious with hold ratings, or are they missing the growth story that Q3 just proved? For investors trying to navigate this, it's important to look at the data the shorts are watching. Right now, the cost to borrow SoFi shares is very low, at around 0.41%. This is an actionable insight. It tells us that this is not a crowded, panicked short position like we see in some meme stocks. It's not difficult or expensive to bet against the company. This suggests the short position is held by larger institutions making a calm, calculated fundamental bet that the macro environment will eventually win. Another figure retail investors are watching is the off-exchange short volume ratio, which has been hovering in the 30 to 40% range on recent days. This data, which can be found on services like Fintel or pulled from FINRA data, shows how much shorting activity is happening away from the public lit exchanges. The days to cover, a measure of how long it would take shorts to buy back all their shares, is also very low, at just 1.53 days. This low number makes a sustained, mechanics-driven short squeeze less likely, as the shorts can get out quickly if they need to. The signals to watch for next week would be any sudden spike in that borrow fee rate, or a jump in the days to cover. That would signal the shorts are getting nervous, but as of now, they are dug in. This explains the extreme volatility we just witnessed. The 10% drop on Thursday was the macro bears pressing their advantage, insisting that the good earnings don't matter in the face of a slowing economy. The 4% rebound on Friday was the fundamental bulls, armed with the Q3 data, buying that dip and arguing that SoFi has proven it can execute despite the macro environment. The company itself is confident, raising its full-year 2025 guidance for revenue, adjusted EBITDA, and earnings per share. This is management telling the market that the strength seen in Q3 is not an anomaly. Looking forward, the path for SoFi is defined by this tension. The primary catalysts are clear. First, continued execution of its cross-selling strategy, turning more of its 12.6 million members into multi-product customers. Second, the continued, steady growth of its technology platform, which provides high-margin, stable revenue. The biggest external catalyst, as CEO Noto mentioned, would be any eventual lowering of interest rates by the Federal Reserve. He stated that would meaningfully boost the student loan refinancing and home loan businesses, two areas that have been suppressed by the high-rate environment. The risks are just as clear. The short thesis could simply be early, not wrong. A prolonged economic downturn, as some analysts warn, is the single greatest threat and could finally cause the credit quality cracks the bears have been waiting for. Competition is also heating up, not just from fintechs, but from legacy banks who are aggressively improving their digital offerings. Comment below with what you think SoFi's biggest catalyst for 2026. Is it interest rate cuts, or is it the growth of the Galileo tech platform? In the end, the SoFi story is a perfect example of expectation versus reality. The expectation is that SoFi is a fragile, high-risk, high-growth bank completely at the mercy of the macroeconomic weather. The reality, as demonstrated by its latest financials, is that of an increasingly diversified and profitable financial technology company with improving credit quality and a rapidly expanding ecosystem. The violent stock price swings we're seeing are the market's brutal, high-volume attempt to reconcile these two opposing narratives. The shorts are betting on a macro collapse. The bulls are betting on proven execution. Friday's 4% rally shows that for now, the data from the company's own report is winning the argument.